Good evening, everybody, and welcome to Le Fund International. I'm Alexandra Georgieva, and we're going to be together for the following 1 hour and a half. So far, great trading session for the US indices, hitting intraday record highs. S&P 500, as we can see, is 0.25% higher. Dow as well, 0.1% higher, and Nasdaq Composite 0.5% higher. Actually, a great trading session for the technological stocks, that's for sure. The VIX index is always at the 12 mark. I want to have a look at 3 stocks in particular, and they are the stocks to watch this evening. One of them is certainly Netflix, which is down after a little bit of disappointing results. We're going to talk about it. Also, Johnson & Johnson, positive results, but as we can see, trading below the flat line by more than 1%. Another stock to watch is Tesla. I mean, have a look at it. This is really incredible performance of the stock, rallying 8%, up by 40% only in 2020. So what can we imagine till the end of the year? And of course, another stock to watch is IBM, 3.31 in the green territory. I want to switch very quickly also to the bond market. The US 10-year Treasury is hitting so far 1.77. As we can see, 0.5% lower this evening. The US 2-year Treasury is hitting 1.52. And the 3-month 1.55. Very quick look also at the dollar index so far at the 97 mark, 0.04% below the flat line. And of course, I want to show you very quickly the European trading session. It's been quite a trading session here in Europe. Stocks essentially closed down by 0.2%. Financial services led gains, while autos and bank stocks led lower. Italian banks led the decline following reports that Luigi Di Maio, leader of the Five-Star Movement and Deputy Prime Minister, has resigned. I just wanted to show you the German DAX. That's incredible. We talked about it yesterday. Actually, the German DAX hit a record high today, this morning, after the ZEF Economic Sentiment Survey locked the highest expectations reading since July 2015, while the current situation gauge saw double-digit improvement. So that's pretty much of a positive news for the German DAX. Despite this fact, it closed 0.3% lower. CAC also 0.6% lower, and the Italian FTSE MIB as well 0.6% lower. We're going to be back on the markets, but first of all, very quick look at the major headlines. The European Union has no choice but to negotiate a trade deal with the US. President Trump told US media in Davos. The United Nations calling for an immediate investigation into the possible involvement of Saudi Crown Prince Mohammed bin Salman in the hacking of Amazon CEO Jeff Bezos' iPhone in 2018. The UK's priority is to strike a trade deal with the European Union ahead of the US, the country's finance minister Sajid Javid said in Davos. Italy's Luigi Di Maio resigned as leader of the anti-establishment Five-Star Movement, calling into question the viability of the country's coalition government. Deaths from China's new virus rose to 17 today, with more than 540 cases confirmed. So situation is getting critical over there. We're going to talk about it. As I said, many stories this Wednesday evening. We're going to cover each and every one of them. I want to start with what's going on in Davos, and of course we're going to have a very quick recap. Trump participation in the World Economic Forum 2020, of course, in Davos. Actually, President Trump said he hoped to clinch a trade agreement with Europe before the 2020 US presidential election, promised overhauls of the World Trade Organization, and signaled concerns over calling witnesses at a Senate impeachment trial. In a wide-ranging news conference at the World Economic Forum in Davos shortly before returning to the United States, Mr. Trump sought to focus on economy, ticking off a list of statistics that he said showed America's unprecedented economic success. We are the talk of the town, so to speak, the president said of his reception at the annual gathering of business executives and world leaders. But the subject soon turned to impeachment trial, which is dominating the attention of Washington and many in Mr. Trump's inner circle, as House Democrats prepare to make their case before the Senate for the president's removal. Mr. Trump said that calling witnesses in the trial would be up to the Senate, but he also indicated that he had national security concerns about allowing former National Security Advisor John Bolton and others to testify. As we can see, actually, what is going on, the impeachment, Democrats prepared to make case for removing Trump from office. The impeachment procedure is getting started over there in few minutes, I believe. On the other side, let's talk about another major story today, and this is regarding Jeff Bezos and, of course, the Saudi Crown Prince Mohammed bin Salman. The United Nations has called for an immediate investigation into the possible involvement of Saudi Crown Prince Mohammed bin Salman in the hacking of Amazon CEO Jeff Bezos' iPhone in 2018. United Nations experts said in a statement, the information we have received suggests the possible involvement of the Crown Prince in surveillance of Mr. Bezos in an effort to influence, it's not silence, the Washington Post reporting on Saudi Arabia. The statement said, the alleged hacking of Mr. Bezos' phone and those of others demand immediate investigation by U.S. and other relevant authorities, including investigation of the cautious, multi-year, direct and personal involvement of the Crown Prince in efforts to target perceived opponents. Certainly, this story is very interesting. The forensic report carried out by Washington-based business advisory firm FTI Consulting on behalf of the tech titan could not detail the specific spyware used in the attack, but said its experts had medium to high confidence that Bezos' iPhone was hacked by malware coming from WhatsApp account used by Saudi Crown Prince. And that's not really surprising considering also the previous reports on the topic. Another story I want to bring you coming from Davos is regarding this time the United Kingdom and possible trade relations with the European Union. The United Kingdom's priority is to strike a trade deal with the European Union ahead of the US, the country's finance minister Sajid said. This came after U.S. Treasury Secretary Steven Mnuchin said that the U.S. was a bit disappointed not to have been able to negotiate with the UK first. In terms of our next step on free trade, one of the big ones is with our European friends and partners getting that new comprehensive free trade agreement where the principles have been agreed upon. That's off to a good start, Javid said, as a panelist on CNBC's Future of Financial Markets panel alongside U.S. Treasury Secretary Steven Mnuchin, IMF Managing Director Kristalina Georgieva, and UBS Chairman Axel Weber. Getting a deal with the U.S. is also a huge priority for us. While nothing, we've already started working closely together toward that goal. Pressed on which deal was a priority, one with the U.S. or EU, Javid said, of course, our first priority is getting the agreement with the European Union. Well, that's pretty normal considering the fact that the United Kingdom is going to exit the European Union by 31st of January, so less than 2 weeks ahead. Certainly, it's extremely important to see what kind of trade agreement there is going to be between the United Kingdom and the European Union. There are many stories to discuss and talk about, but let me first bring to the show my first guest this evening, Matthew Malley, Managing Director at Miller Tabak. Good evening, Matthew, and thank you for joining us.
Thanks for having me, Alex.
Matt, I would like to start with the U.S. markets. Great performance today, very positive reaction of the earnings season so far. What is your comment of these valuations?
Well, it's, obviously the market continues to act well. I mean, the earnings are coming in well, and when they always beat expectations. But it's still going to be something where it's just the fourth quarter is going to be only slightly up, and the full year is going to be basically flat for 2019. Of course, that's backward looking. And the forward guidance, for many companies has been good, but we still see the overall projections for or estimates for the S&P for the full year 2020 really haven't changed much, and we're still early in the process, so I don't want to say it's too much of a negative thing. But the point is that this is very much a momentum and liquidity-driven market right now, and I don't think that the earnings are really the main catalyst for this as much as it is momentum and liquidity.
That's very interesting. Great valuations over there. I just wanted to show very quickly to our viewers J&J because it's down by 1.22%. Let me just bring very quickly the numbers to the viewers. Johnson & Johnson profit and sales rose to the fourth quarter roughly in line with Wall Street estimates. The New Jersey-based health products company reported net income of $4 billion or $1.50 per share compared to $3.04 billion or $1.12 a share in the year ago. Excluding special items, Johnson & Johnson earned $1.88 per share. Worldwide sales rose to $0.75 billion from $20.39 billion for the same period in the prior year, and analysts were looking for $20.8 billion. U.S. sales rose 1.4% to $10.77 billion from the comparable quarter a year earlier, and international sales rose 2.1% to $9.97 billion. And of course, Johnson & Johnson guided adjusted per share earnings of $8.95 to $9.10. For 2020, the company said it sees operational sales of $85.8 billion to $86.6 billion. The company expects adjusted operational sales to grow 5% to 6% from a year ago. Matt, we do see a little bit of mixed results. What is your comment on the results?
Johnson & Johnson?
Exactly.
Yeah, it's interesting. One of the things that as much as the stock is down, and there's no question, when a stock gets hit on earnings, it's always a concern. But in this case, it's not a big concern for me. Now, one of the reasons why is the stock has had this tremendous run since the October lows. It's outperformed the rest of the market by quite a bit. It was actually one of those big lagging stocks through most of this year, and it's finally starting to play catch-up. So the fact that it's pulling back today is not a big surprise to me. In fact, even if they had reported right in line with estimates, I think the stock would have experienced a little bit of sell the news reaction, and that would not be the worst thing. The stock has been gotten very overbought on a short-term basis. The thing is, what does it do next? And this could be one of these stocks that, like I mentioned, had been lagging through much of last year, and if it breaks out above the 150 level in any kind of meaningful way, I mean, whenever, I don't want to say 151, but if it gets a little bit, in a more meaningful way, up near 153, 154, that's going to show a technical breakout in the stock. I mean, that was a double top high from 2018, and it'll be very, very bullish on a technical basis. So I think this is actually positive for the stock, because it's kind of collecting itself and correcting itself a little bit to work off that overbought condition, which will help it rally further once it finally does break above the 150 level. So if you're bullish on the market and bullish on the healthcare group, which I am, this is a stock that I like. I'll like it a lot better if it breaks above 150. But I think if and when that happens, investors can continue to be aggressive on that stock.
I want to talk about Netflix because yesterday we saw the Q4 earnings from Netflix, and there is something very interesting because the company missed its forecast for U.S. subscriber growth for the third straight quarter, but blew through its expectations for overseas expansion, a mixed performance that comes as the streaming giant faces heightened competition from a gaggle of rivals. Of course, I'm talking about Amazon, Apple with the streaming services, not to mention Disney, which is rocking. What is your comment on the stock, and what is the chart saying in particular to you?
Well, the stock really is at a key, you say on the chart, it's at a key technical juncture, and whatever it does in the next, literally in the next week or so, is going to be very, very important going forward, and for the rest of the year, certainly for the next 6 months. And one of the reasons why I highlight, well, first of all, of course, we all know that Netflix has a lot more competition. They no longer have a monopoly, even a quasi-monopoly, but this is something we've all known for quite some time. The thing is, though, as you mentioned, you asked about the chart. It's getting down to getting down near its 200-day moving average. This has been a key level for the stock. It broke that over the summer last year in July, and when it did, the stock just got absolutely clobbered. It fell over 20%. I think it was about 23%. If the stock breaks below its 200-day moving average this time, I think it could be in for another deep decline of more than 10%, maybe 10 to 15%. However, if it holds that line, holds that support level, and bounces strongly, it's going to be quite bullish for the stock. And the reason why I highlight that is that, number one, yes, 200-day moving average is support, but it's coming very close to a golden cross. You hear about these death crosses and golden crosses. Golden crosses are when the 50-day moving average crosses above the 200-day moving average. But the thing is, for this stock, ever since the the credit crisis, the financial crisis of 10 or 11 years ago, every time there's been a golden cross, the stock has rallied very strongly. So if you can get a nice bounce off that 200-day moving average, you'll probably get that golden cross, and the stock will take off and won't rally more than 10%. So I guess my point is, right now, I think investors should. Sometimes the right thing to do is just sit and wait and see what happens. I think that'll be the right thing to do, because even if you miss a couple of percentage points at the beginning of the move, it's okay, because I think you're going to see a double-digit move rather quickly once that move is once that we've established whether it's going to break down or bounce off that 200-day moving average.
So can we conclude that you are bullish on the stock?
No, right now I'm neutral, I guess is the point, and I'll let the stock tell me. I'll let the stock itself tell me what's going to happen next. To be honest with you, I'm a little concerned about their competition that you just talked about. So if anything, I'm leaning slightly to the bearish side. But I'll let the stock, on the technical side, I think whenever a stock reaches a key technical juncture, I always like to let the stock itself tell me what's going to happen next. And the thing is, in today's markets, where momentum is such a key player, and these algos and stuff, this computerized trading, once it starts moving in that one direction, the momentum tends to take it quite a way. So I think this is one where we want to sit and wait, and when we see it really break, then you move, then you react.
What is your general assessment of the blue chip stocks? What kind of earnings, what kind of results do you expect, because we're yet to see them?
Well, to be honest, the market is getting overvalued. Now, there's no question. We can argue whether or not these high valuations are legitimate or not, or in other words, can be justified. Some people would say that with interest rates as low as they are, there were a higher multiple, a higher PE ratio, a higher valuation is okay. The thing is, the market keeps going higher, and yet interest rates really have stabilized in the last year or so, and they're off their lows, at least on the long-term interest rates. Same thing with short-term interest rates are certainly not down at the low levels they were a few years ago before the Fed started tightening. So my concern is that the market is overvalued, but we have a lot of help from the Federal Reserve. We have a lot of help from other central banks around the globe. So this market can go, can keep rallying for a while. But to me, I just think it's the right thing to do right now is to be a little defensive. You can let your winners run with new money. I think you want to put some of it into some more defensive names. We see the utility stocks acting very well. I just think that if you're trying to make that very last the last few percentage points in this rally, you tend to get burned, and we're also see a lot of complacency in the market with a lot of these. This morning there was a investors intelligence poll which put the spread between bulls and bears at 41.5%. That's the widest it's been since October of 2018, and that was just before we saw the big deep correction of the fourth quarter of that year. So it's getting a little frothy. It could go higher, but I just think some new money should be spent on more defensive plays.
Matt, there are so many stocks I would like to talk about, but I want a very, very brief opinion regarding the IBM. I don't know if you follow this stock, but it's trading pretty positive today after yesterday's earnings results. It's 3.22% in the green territory. Did you expect this rebound in terms of earnings and profits?
No, we do not cover IBM, but I can say this: this is a company that it's. To me, there's two ways to look at it. Number one, you say, well, geez, the company's finally turning things around, and that's positive. You go back in the late 1980s, 1990s, it was the most important technology company in the world, at least in the early 1990s. And of course, it's not that anymore. But it hasn't disappeared either. It's still very, very important. They're very highly involved in the cloud, and they seem to be turning the corner in that area. So it can, usually when you see a big name finally, a big important name that's been lagging for a while finally starts to play catch up, that's usually a good sign, and usually going to let it run. But when you get a market that's as overvalued as it is, the upside I think is going to be a little bit more limited. And then you also got to look and see if you really think the market's got a lot further to go, and you think this rally is going to continue. Are you really going to go with the kind of the old dinosaur like IBM, or are you going to go with some of the newer names that are on top of the newest technologies that are in the world right now and really innovative? So I don't want to say I don't like IBM. I think what they're doing is very positive. It can be a good a core holding, but it's not the one that's going to help you retire. I mean, it's going to help you retire early, I guess is my point.
Matt, let me ask you one last question. Your opinion regarding Tesla. Tesla is such a surprise for the market. It delivered also in terms of supply regarding, of course, their last car model. I just wanted to show you the stock here. It is almost 8% in the green territory, up by 40% in 2020. That's really incredible. Also great end of 2019 for Tesla in terms of chart, also in terms of fundamentals. How far can we go, and are you concerned on future supplies?
Well, yes. I mean, we got to look at two different things: the trading aspect of the stock and the long-term fundamental aspects. And even if you're a long-term bull, I don't want to say I'm skeptical, but I believe in a long term as long as they can. Elon Musk has finally done what he needs to do to help this company. Keep his mouth shut basically, and do his job, and stop worrying about tweeting all the time. That's been a very, very positive development in this situation. But that's a long-term play. On a short-term basis, we have a situation, I believe, there's one of the greatest opportunities on the downside in a stock is when you get forced selling, when they throw the baby out with the bathwater, because people are highly leveraged in a name and they're forced to sell it even if the stock is cheap. Well, we're getting the opposite of that right now in Tesla. We're getting, this stock was heavily shorted, as we all know, and some high-profile hedge fund players were very short the stock, and they're getting absolutely creamed, and they're being forced to buy the stock, even though it's getting a little bit out of control to the upside. They have no choice. They're losing money. They're getting margin calls, and they have to cover the stock. It's forced buying, and so therefore, once the forced selling, when the forced selling ends, like we saw in the stock market in 2009, boy, it just bounced like a rubber ball, huge bounce. The same thing happens when you have forced buying. And once the buying stops, the stock comes down quite hard afterwards, even though it might go a lot higher longer term. So I just think if you don't have a position in the stock, I wouldn't be chasing it up here. If you own the stock and you believe in it, there's no reason you have to take. You can try to trade around it and take some chips off the table and buy back some of it later, things like that. But right now, I just think that we're going to, at some point in the not too distant future, we're going to see a big downdraft in the stock. On a short-term basis, that's going to hurt a lot of people. On a longer-term basis, it probably won't be a big issue.
That's very interesting. Thank you very much for this conversation. Malley, Managing Director at Miller Tabak. Thank you for joining us, and have a great day.
You too, Alex. Thank you very much.
We're heading for a very short commercial break, but stick around because up next is a comment of the World Economic Forum 2020. Welcome back. So far, S&P 500 is 0.2% higher. As we can see, great levels over there, 3,330 points. We're at the 333 level. Well, that's a very special number. Dow on the other side is 0.14 in the green, and Nasdaq Composite a little bit more than 0.5% in the green territory. The VIX index, as always, at the 12 mark, lower by 1.5% this evening. The blue chip stocks are doing great job today, except Netflix, of course, after a little bit of disappointing subscription results, not earnings results for the Q4, that's for sure. And when we talk about subscription results, I'm talking about the domestic subscriptions results, because as we were talking with my previous guest, international one were pretty interesting and pretty good. I want to switch very quickly to the bond market. So far, the US 10-year Treasury is yielding 1.76, the 2-year 1.52, and the 3-month 1.56, and the dollar index pretty flat, but 0.03% below the flat line. We're going to be back on the markets, but let's get straight to the major headlines. The European Union has no choice but to negotiate a new trade deal with the US. President Donald Trump told US media in Davos. The UN calling for an immediate investigation into the possible involvement of Saudi Crown Prince Mohammed bin Salman in the hacking of Amazon CEO Jeff Bezos' iPhone in 2018. The UK's priority is to strike a trade deal with the European Union ahead of the US, the country's finance minister Sajid Javid said in Davos. Italy's Luigi Di Maio resigned as leader of the anti-establishment Five Star Movement, calling into question the viability of the country's coalition government. Deaths from China's new virus rose to 17 today, with more than 540 cases confirmed, increasing fears of contagion from an infection suspected to originate from illegally traded wildlife. Well, that's pretty much of a story, and we're going to comment, and I'm going to bring you the latest details, that's for sure, a little bit later on the show. First of all, I want to talk once again about President Trump's behavior at the World Economic Forums. The last story is that, of course, he threatened the European Union for big car tariffs. The European Union has no choice but to negotiate a new trade deal with the US. President Trump told US media earlier today the president met with European Commission President Ursula von der Leyen at the World Economic Forum in Davos and said that the pair had a great talk. Amid ongoing informal discussions, Trump has threatened to slap tariffs on European cars in a bid to strong-arm EU leaders. In yesterday's meeting, he claimed to have told von der Leyen that absent a trade deal, he would need to take action in the form of very high tariffs on their cars and other things. Well, that's not really surprising if we think about it. But in order to comment these major stories, let me bring to the show my next guest this evening, Jan Ergas, Chief Economist, Argus Financial Partners. Good evening, Jan, and thank you so much for joining us.
Thank you very much, Alexandra. Always a great pleasure, also a very good honor. Thank you.
I just wanted to remind everyone, I knew that the World Economic Forum in Davos 2020, the major topic was supposed to be climate change, sustainability, sustainable investments or ESG investments, and of course international trade. We already did see betterment in terms of international trade because the US struck few deals with Mexico, Canada, and not to mention the Phase 1 trade deal, which has been the major success. So President Trump did something very interesting. He had two speeches, and both of the speeches were focused on US economy, which is certainly doing a great job. I mean, no doubt about it. Numbers are there, so I mean, we cannot say the opposite. But do you think his, how can I say, presentation as a government figure, as the leader of the US, was the right one at the World Economic Forum?
Well, I think the first thing you have to ask is, why are we still listening to the World Economic Forum? To what extent does Davos represent sort of a current of opinion which is still tenable today? Remember that the World Economic Forum was the pioneer forum for globalization, which may have had many good points, but has led to many distortions, and in fact has led to the presence of people like Donald Trump in government. I think the first question we have to ask is it necessarily the agenda set out by these people an agenda which is realistic and in line with the expectations of a large part of the world's population? I don't think it is, quite frankly. I think with regard to the direct intervention by President Trump, I think that Trump is certainly right in emphasizing the successes of the US economy. There's no way you can come around this, whether you're a Trump supporter or not. We have the number is below 4% unemployment. And much more important, I think Trump was absolutely correct when he said that this has been a blue-collar economic boom in the sense, or growth or recovery, in the sense that now you are absorbing parts of the labor force which previously had not been absorbed, and people are getting jobs. And he talked about a roaring geyser, if I'm not mistaken. Maybe that's a bit much, but I think that certainly in comparison to other economies, it is doing well. So I think, yes, it is electoral. It is addressed also to those constituencies which he needs to win, which are the industrial constituencies. And is a discourse also of critique in relation to certain policies followed by other countries as well. Trump is basically saying, we focused on the US, right or wrong, this is what we achieved, you focus on your countries, and you may do better.
Yes, on the other side, European leaders had completely different opinion because
Sure.
Trump, of course, how can I say, vowed for unilateralism, and European leaders multilateralism.
Exactly.
So which is better at this point for the economy, multi or unilateralism?
Well, look, I don't know. I think basically, I do know in a sense that I think that basically multilateralism has basically run its course at this point. We have tried multilateralism. We have tried the WTO, which has proven to be extremely cumbersome. What we did see emerging aside the WTO or beside it were these multilateral deals, what are called club deals between countries, where countries with similar interests struck deals to further their economic position, let's put it this way. And so we have talks of free trade agreements between 3 countries. We have customs unions. We had NAFTA. So I think, look, quite frankly, I think at this point, the game is very simple. We're back to a bilateral world. We're back to the world almost of the Cold War. China and the US control about 40% of global GDP. With 40% of global GDP, you control the world. This is like 2 shareholders who have 40% of a company, and the other 60% is widely dispersed. So who is going to have to say there? So then whether we like it or not, we're moving towards bilateralism, because these are the key trading relationships, the US and China. And what the US and China decide will then be passed on to the other participants. So I don't know if multilateralism at this point is still really a viable option in practical terms and expediency.
I've been interviewing many people from very different parts of the world. What is your opinion on climate change, and do you think leaders are doing enough how can I say, to tackle this issue?
Well, look, the climate change issue is obviously a big issue. We're seeing it also in Italy here, where we are right now. I have the pleasure of being in your studios. For example, I know people who run hotels in ski resorts, and they've had a very difficult time for a number of years.
Absolutely.
So this is obviously happening. This is not true. We're seeing the effect, for example, in places like Venice, with high water, which could destroy historical landmarks.
Absolutely.
So we're actually seeing this. The question is basically what do you do about it, and who's going to do what, and who's going to do the talking, and who's going to take the action. I think world leaders are attempting to tackle the issue. The first thing they've done is they've recognized that it exists. Now, that said, it is very expensive and could get in the way of economic progress if they actually do tackle this issue, for example, on certain emissions. Which do we prioritize? Clean air or people having jobs? Can we make all industry, let's put it this way, carbon neutral? Now they have the border taxes on carbon neutral. This is the great idea of the European Union. Who is going to pay them? Who is going to monitor this? So I think it is very complex. I think Trump's critique is not totally mistaken in the sense of, I grew up in the 60s, I'm 64, and I remember there was the famous population explosion story, that we were all going to starve because there was going to be no more food. Well, we didn't starve, we had plenty of food because technology adapted. Is this a valid analogy or not? I don't know. I think there's alarmism. I think we have to distinguish between alarmism, quite frankly, Greta Thunberg, I'm not taking positions either side, and actually what we can actually do. It is very easy to talk about sustainability if you're a big company, being carbon neutral footprint and so on and so forth, but it is very difficult for small and medium-sized enterprises to actually put in those systems or renounce the use of certain energy sources and still be profitable and generate employment.
And do you think these measures that have already been undertaken from several important companies, we've heard many CEOs, exactly the World Economic Forum, who said that they have undertaken measures in this regard. Can we expect decline of the energy stocks and oil price, or you think the oil is here to stay?
Oil itself. Oil. I think oil is certainly here to stay. I don't think oil is going away tomorrow morning, quite frankly. The question is not do we abolish oil, the question is how do we use oil responsibly, both in terms of the available resources and what it will do to the environment. Now, we've also seen these initiatives which are being sponsored by the big four accounting firms, the designation of certain metrics, the inclusion of the results of these analyses in financial statements by large companies. This is all well and good. The question then becomes, how quickly can you apply it? What does it mean? Will it be sufficient? And I really would look at the use of energy. To what extent are we willing to sacrifice economic growth today for a cleaner tomorrow? And I think when the chips are down, as I say in the United States, when the reckoning comes, very few countries in this moment with a slow economic growth are really going to be willing to put on those constraints.
I want to talk about the European Central Bank. Of course,
Sure.
Tomorrow is going to be the second press conference of Christine Lagarde. Let me just have a very quick look at the euro dollar so far, 1.1085, as we can see, 0.03% higher. First of all, we don't expect many surprises, that's for sure. But I wanted to point out, just for our viewers, that today we saw the German stocks, which hit a record high in the morning after we saw the DEF economic sentiment survey, which of course logged the highest expectations rating since July 2015, which is pretty good of an indicator. So do you see a light in the darkness over there?
I think maybe some light in the darkness, but it's been very, very dark. Let's put it this way. I don't think we're in the bright sunshine. I think it's a little less dark. So I think there is some light in the darkness. At a certain point, industrial slumps do bottom. This does not mean that there's a big snapback. I think people are distinguishing, saying, or rather are not discerning sufficiently between a stabilization, let us put it this way, a slowing of a rate of contraction, and an immediate snapback. The two can be deferred in time. I can have a slowing of the rate of contraction, but before I really start moving forward again, can take some time. So I think we have to be careful here. I think there could be something going on in Germany. Will Germany bounce? Will it mean 3% growth in Germany? I do not think so. What we are possibly doing is we're eliminating the worst case hypothesis, which remains a favorable hypothesis, which is no recession. We stumble through, and eventually, all simply on the basis of restocking and rebuilding inventory, which is being depleted, industry starts moving again. I think that's important.
And in terms of the European Central Bank, what can we expect tomorrow as an announcement? Are we going to see any surprises, in your opinion, after this, how can I say, change in the economic outlook?
Well, I don't think we're really looking at a change in the economic outlook as of yet, because the story of the green shoots has been on for some time. Remember also the IMF has also downgraded its outlook.
It did, but it was very small downgrade.
Very small downgrade.
I mean, it's almost none of a downgrade.
I don't know. I mean, if you look at India, obviously maybe had the key role. But I think that basically what is being said now is, we may be stabilizing slowly. So I think the ECB is not going to rush to any decisions. The ECB will say, you know what? We possibly may have an incipient, let's put it this way, stopping of slowing stabilization, but this will not be sufficient to spur a change in monetary policy at this point. And what we really have to look at the ECB is what they do on their inflation targeting, and whether they become more flexible and say, we're willing to admit or accept an overshoot over this famous 2%, which they have still not been able to reach by a long shot, as long as it's sustainable, because guess what? We want to see prices rise, so that will mean interest rates lower for a longer period of time. I think it's very, very important that what is actually happening in the European Eurozone is that bank credit is very important to small and medium-sized enterprises, simply to keep them moving as a going concern, because the one source of capital they have, as opposed to the United States, where you have diverse sources of capital flowing into different segments of the economy by size.
But can we expect this negative interest rates environment to last for a decade?
I think we expect it to last for quite some time.
Like a decade?
Like 4 or 5 years, yes.
Well, that's pretty much the time.
I think it could be 4 years. I think before they actually really start to move.
And what can we expect from the European bonds? Because they're mostly yielding negative. Can we expect some gains over there? Actually, I just wanted to point out for our viewers that the German 10-year bond is slightly higher as a yield, of course, negative 0.26, but still higher.
Yes, I mean, I think that's largely noise because, look, There is a new fixed income parity yield, and this is zero. Okay, so it used to be that we used to look at bonds and say, have they broken the 10% yield barrier? That used to be one of the metrics of my youth. Now we're saying, have they broken zero? And I think the simple point that we are asking this question, I think is quite significant. But if we start thinking that minus 26 basis points on a 10-year is moving and yields are rising, this must force us to rethink all the paradigms we have used up to now. So I think it's largely noise. I don't believe there's going to be big gains on the bonds in terms of, let's put it this way, bond prices rising at this point. However, I do not see yields going through the roof. I don't think there's safe haven buying going on as well. But the general prospects for the economy remain relatively muted.
I want to bring to the show another major story, and it's regarding Italian politics. Today, Italy's Luigi Di Maio resigned as leader of the anti-establishment Five-Star movement, calling into question the viability of the country's coalition government, with his fading populist party facing a trashing in regional elections this weekend. 33-year-old Di Maio told a meeting of Five-Star ministers today that he's stepping down from his party job. According to, of course, members of the party, he plans to stay on as foreign minister and will make a public statement. Actually made a public statement already. Di Maio's exit from the party job will add to speculation, of course, that Italy is veering toward a national snap election that could see right-wing populist leader Matteo Salvini winning over there. As I just said, the regional elections in Emilia-Romagna next weekend are going to be extremely important. I just wanted to show very quickly to our viewers the Italian 10-year bond at 1.34, as we can see, lower by almost 1.5%. And of course, the spread between the Italian BDP against the German Bund, 160 basis points, as we can see, lower by almost 0.5%. So, Jean, first of all, what is your comment on this sudden resignation, and how long do you think this coalition is going to last at this point?
I don't think it's going to last very long, but I think it's a coalition made up of, quite frankly, parties which have radically different views. It was basically a coalition sponsored by Five-Star, PD, as a means of the Five-Star asserting its power against the League, which it thought was going to eat it up. What has been the result? Very little on the economic front, bumbling along, and for the Five-Star itself, it has seen its support shrink from 33% to estimated 16%, and therefore will not do very well, let's put it this way, at the Emilia-Romagna regional elections. So I think the real point is basically this, is that you're going to have, to my mind, relatively poor performance by the existing government coalition in these important regional elections. If the League and it wins with eyes, then we're going to have a situation where the League Plus has won in a historically left-wing area, which is considered a bastion of the left in Italy. And this is going to have very big ripple effects, because it could mean that we're starting to see something we saw also in the UK with a Conservative victory, when the Conservatives won not by the expected 20 seats most people thought they were going to get from traditionally marginal, maybe Conservative seats, but from parties, from places that had never in their lives voted Conservatives and had always returned solid socialist Labour majorities. So we may start seeing here a UK effect. I think it's very important. I don't think this government is going to be around for very long, quite frankly, because they will be delegitimized by the regional elections.
Absolutely. And what kind of outcome do you expect in Emilia-Romagna?
I expect the League to win. I expect the League to do very well and possibly also to win. I do not think this is a long shot, this story. I think we are seeing a really tectonic shift take place in Italy, where disillusioned leftists are actually teaming up with people from the right to vote for the League. I think it's very important to understand what the League represents today. The League represents today a group of people who are fed up, rightly or wrongly, who do not see the country moving forward, who are disillusioned with the left, who they see as pursuing a policy which is basically favoring the rich, who do not want the Five-Star movement, which has shown itself incapable of acting as a political party with a program, as opposed to a grassroots movement. I think this is the real point, that you had a party which had got 33% of the vote, which, however, was not able to transform itself from a movement, almost anarchic, into a concrete political force, able to formulate and put through a coherent policy.
Well, it looks like, can we expect any reaction from the markets? Because we do see a little bit of slide in terms of the bond market. Also, FTSE MIB closed 0.6% lower. But I just wanted to highlight the fact that investors and, of course, citizens, Italian citizens, are already kind of used to this situation with the government, because we do see, how can I say, insecurity in terms of political point of view for a very long time. And another thing I wanted to highlight is that FTSE MIB was the 6th best performing index globally in 2019, which means somehow that it does not reflect the Italian economic situation, or you have different opinion?
Well, first of all, I think you're absolutely right, Alex. I think you're very sharp in pointing this out, that there's a distinction between the Italian economy, or an economy, and a stock market domiciled in that economy. Because very often the companies that do well are those that have very extensive presence abroad, and therefore there's no symmetry between place of domicile and source of cash flow. Okay, or it could also be a company operating domestically, which has a brand, which has a niche, and therefore has pricing power. Because remember, the Italian economy is not all bad. I mean, there are some spheres which are doing very well. Market reaction. The markets do not like Mr. Salvini for whatever reason. But I will say one thing, that since Salvini's departure, Christine Lagarde has come out and explicitly supported many of the Salvinian ideas, which are basically the increase in the fiscal policy. So the ideas that Salvini and co. were actually put forth are no longer as heretic as they were previously, because everybody's saying governments must spend more. So I think there will be a muted reaction. I think the markets are building up to it. There'll have to be at some point a general election if they are completely delegitimized, and then we're going to take it from there. I think obviously the EU constraints will remain, but the tensions will remain as well. Remember, this is a country with an absolutely enormous public debt. The game in Italy is not being played at the level of the private companies. The game in Italy is being played at the level of the sovereign accounts. And that's where the pressure will always be. But companies can continue to do very well if they position themselves correctly.
Well, I mean, it's a very interesting situation, because on the other side, we were just observing after some reforms, especially the pensions reform,
Sure.
that was done. It was the idea of Salvini, caused many damage from economic point of view. But certainly we're going to see what is going to happen now. I mean, we don't know what is going to happen, because we never know. I wanted to bring you the latest regarding the China virus, because stats from China's new virus rose to 17 today, with more than 540 cases confirmed, increasing fears of contagion from an infection suspected to originate from illegally traded wildlife. The previously unknown flu-like coronavirus strain is believed to have emerged from an animal market in central Wuhan city, with cases now detected as far away as the United States, contrasting with its secrecy over the 2002 and 2003 severe acute respiratory syndrome, or the so-called SARS, that killed nearly 800 people. China's Communist government has this time given regular updates to try to avoid panic as millions travel for the Lunar New Year. Well, it came also to Washington. We have the first patient over there,
Yes.
confirmed yesterday. Jean, very briefly, how concerning is this story, or you think that doctors have it under control?
Well, look, you just don't know, because this is the ultimate risk, like war. I mean, not for nothing, there are the four horsemen of the apocalypse, one of whom is war, and the other one is the plague. Now, if we've avoided the war, Iran, US, hopefully this is not going to be the plague. I'm not trying to be too dramatic. But you cannot assess it, you cannot monitor it that easily. I believe that they controlled the SARS reasonably well. Unfortunately, 100 people died. I think in China, they said they're going to take very strict measures. I think the markets will wait for more news, but remember, the markets can move on a even slight change. If 2 people die, then it's much more than the impact of 1 person dying. I mean, unfortunately, I hope nobody dies here. So I think it's very much up in the air. I think the markets will look at it. It can be concerning, but I think we have to remember the Chinese economy is much bigger than it was before. It is internally focused. There is online shopping in China, which means people do not have to leave their house to go shopping, which means commerce can still continue. There's one of the big things of SARS was that people stayed home and did not go to the shops, because maybe Jack Ma's inventions will help. I think it's going to be a tough slog. I think we will only notice over time. It's going to be completely non-linear. This is what's the problem here is you don't know. Suddenly nothing happens and suddenly 100 people die.
All right. Certainly, we're going to follow the developments because actually the death toll is already to 17, which is also a little bit concerning because from 3 to 17 in 48 hours.
It's the jump.
It's a major jump.
It's a jump.
All right. Thank you very much. John Ergas, Chief Economist, Targus Financial Partners. Thank you for joining us.
Great pleasure. Always a great honor. Thank you very much. Thank you.
Well, we're heading for a very short commercial break, but stick around because up next is chart analysis together with Domenico De Giorgio. Welcome back, everyone. So far, S&P 500 is 0.3% higher, 3,331 points, which is a remarkable figure over there. Dow as well, 0.3% higher, and Nasdaq Composite a little bit more than 0.5% in the green territory, 9,424 points. Great performance of the technological sector, and of course the blue chip stocks. We also saw great earnings for the blue chip stocks. Netflix is the only dark spot over there, almost 3.5% in the red territory, but all the rest are doing pretty well today. I want to bring you an update regarding Boeing, actually, which is 0.6% lower. I just wanted to tell you that Boeing pushed back its forecast for when regulators will clear the return of the 737 MAX to commercial service, saying it doesn't expect approval until mid-year at the earliest. So as we can see, there is a little bit of reaction over there, a little bit more than 0.8% in the red territory. We're certainly going to be back on the markets, but first of all, very quick look at the major headlines. The European Union has no choice but to negotiate a new trade deal with the US. President Donald Trump told US media in Davos. The UN calling for an immediate investigation into the possible involvement of Saudi Crown Prince Mohammed bin Salman in the hacking of Amazon CEO Jeff Bezos' iPhone in 2018. The UK's priority is to strike a trade deal with the European Union ahead of the US, the country's finance minister Sujitjovic said in Davos. Italy, Luigi Di Maio resigned as leader of the anti-establishment Five Star Movement. Deaths from China's new virus rose to 70 today, with more than 540 cases confirmed, increasing fears of contagion from an infection suspected to originate from illegally traded wildlife. As we were commenting with my previous guest, that's pretty much of a story. And of course, we're going to bring you the latest a little bit later. I just wanted to I have a very quick recap regarding President Trump's behavior at the World Economic Forum 2020. Actually, President Trump ended his participation in the World Economic Forum, saying that he hoped to clinch a trade agreement with Europe before the 2020 U.S. presidential election, promised overhauls of the World Trade Organization, and signaled concern over calling witnesses at the Senate impeachment trial. Of course, he threatened the European Commissioner Ursula von der Leyen that if, of course, Europe doesn't react very quickly to the U.S. demands, there are going to be a big car tariffs on EU imports. So that's pretty much of a deal. He, of course, praised the U.S. economy performance, which is, as we very well know, brilliant compared to the other European countries, or even China or South America, whichever of them, that's for sure. But the point is that the World Economic Forum 2020 was supposed to be focused on climate change. So in order to discuss this topic, let me bring to the show Domenico De Giorgio, professor at Cattolica University. Good evening, Domenico, and thank you so much for joining us.
My pleasure, as always, and good evening, everyone.
I just wanted a very, very brief comment regarding President Trump's participation in the World Economic Forum. And do you think the values that were supposed to be, how can I say, showed during the forum, this year's forum, managed to be done?
Well, to be frank, Trump has used this venue more as a mean of a propaganda for his own election later this year, rather than as a way to join the global attention on climate change issues and inequality. Now we know that he is very much of a free shooter. So he doesn't quite care what others say, and they've made no exception. So he went there to glorify himself and to threaten more retaliation against Europe if we, as a set of nations, go and pursue these tax loopholes that are actually allowing these big U.S. corporations to shield and shelter money in these tax havens, and that is really where the whole point is. Trump is using his stronghold to leverage his own position with the automotive sector in Europe, and he knows that that is our weak spot. It's been over a year and a half now that automobile and auto parts industrial sector in Europe is dragging down our growth as a Eurozone. And so he knows that that is our weak spot. Now this retaliation that he's trying to bring forward against France for their alleged attempt to devise this technological and internet taxation rule mechanism in France, and he's using the German automotive sector as a counterweight to threaten more retaliation on US imports, which is precisely European cars. And so you see, he's always there mixing a bit the waters and confounding what is really at stake here. We should try to work together as a world, a developed world, towards a steady pressure on developing countries such as China and India to become more environmentally friendly, okay, because at the margin, it's them making this huge disaster climate-wise. And on the other hand, he ignores this very well worthy situation, climate-wise, to pursue his own agenda, that is glorifying his steady growth in the United States, the very low jobless rate, and the very strong, as he says, growth in corporate America.
I was wondering, I mean, just if we have a look at the US indices, all the three major averagers definitely overvalued. How far can we go with this market's valuation?
Well, really, they're not that highly valued if you adjust them for the very low interest rate environment we're living in. Now, most of the commentators often stick to the earning growth, okay? And now, if you only look at that metric, really, you may start saying, yes, perhaps we're inching into an overvalued territory. But when you compare that environment, that is the risky assets growth, with the safe assets performance, that is interest rates, well, then there's no gain. As long as interest rates stay this low, it was very clearly said in a Moody's report a couple of weeks ago. Moody's said exactly what I'm saying, what I've been saying for months. As long as interest rates stay this low and longer dated interest rates yields don't inch up, then there simply is no other investable asset where money can pour into.
So you say there is no better option to the stock market. Is this what you're saying?
That is what I'm saying.
And is it the same story for European equities, or you're just referring to US equities?
I'm only referring to US equities because there you have this very much Goldilocks environment. You have steady, positive, real growth. You have overall low interest rates, and you have a very strong consumer spending environment. In Europe, we have negative rates, and that is dragging on the growth of a number of industrial sectors, eminently insurance and banks. These two sectors, which are much more relevant for the overall European economy than the US, are dragged down by negative interest rates. And in spite of Europe clocking a 1.2, 1.5 annual growth rate in GDP, these negative rates are dragging down precisely those industrial sectors that are the cornerstone of our growth, that is banking. In Europe, the banking sector is so much more important than in the United States as a facilitator for our growth. And that is why US stocks with these ginormous corporations, it's now 4 worth more than $1 trillion, okay, if you think that Nestlé, the largest European company, is only $250 billion worth, and that's the largest European company, whereas in the United States you have four giants, each worth more than $1 trillion. That says a lot. And yes, that is why United States stocks are the unique place to be when there's no other, there is no alternative China bull market stocks.
I was wondering, tomorrow is the ECB press conference. Certainly we do not expect any surprises. Today we saw the ZEF index, the German ZEF index, performing best since 2015. Of course, this boosted major rally for the German DAX throughout the day. Of course, not the closure, because after hitting new all-time record highs, it closed 0.3% lower, but still levels for the German DAX are great so far. First of all, how far do you think we're going to remain in this negative interest rates environment here in Europe?
It's a great question, and I could not be more contrarian to the idea of negative interest rates in Europe here and now. I fear that we're going to stay here much longer than needed, and this is why our growth in terms of equity valuations will keep on being low and slow compared to the United States. Tomorrow, I will be looking very carefully at what Ms. Lagarde is going to say about this review about the European Central Bank policy. And I hope I'm wrong, but I fear that it will all sound more dovish rates-wise. I've been reading reports and suggestions that all that is labeled as green investment will be exempted from the monitoring of the European Central Bank as a source of inflation. So in other words, the European Central Bank won't be reacting rising rates when inflation is generated by spatial economic environments, such as those advocated to the energy and environmental awareness. And if this is the case, well, then rates will stay low for so much longer than needed, because the source of inflation are exactly being silenced. If you remove gasoline and energy prices, if you remove tobacco, and if you remove all those investments that generate inflation from the green economy, so to speak, then what is left? In an aging population as Europe sports, with median age being the highest worldwide, how can there be any inflation? So I will be very much monitoring tomorrow whether Mrs. Lagarde is going to say something about what core inflation is and how the European Central Bank is going to behave towards the headline inflation rate. Because if they become more tolerant on a headline inflation rate, that means that in the future, the European Central Bank will be lagging behind the curve much more than today, and that means lower rates going forward.
And do you think we're going to see any gains from the bond market? Because, I mean, it's been very successful, especially the US bond market in 2019. But can we expect the same story for the European bond market in 2020?
That's a tough question, because we go back into the regional politics, okay? So God only knows what happens if something goes wrong in Italy, for instance. And so will we be seeing a safe haven behavior of the German Bund, or will we be seeing a deflationary overall trend across Europe, regardless of what happens in the regional politics? That is a bit of a gambit, in my view. I believe that as long as there is no political risks, and I do see sources of political risks in Italy.
Of course they are. I mean, Luigi Di Maio
Yes,
just
exactly.
resigned. So you know the coalition is not stable at all. We don't know how long it's going to last. So in terms of political risks in Italy, there are many of them.
Precisely, and Italy is not Spain, Italy is not Belgium. So I would like to answer to this question next week after the regional elections in Emilia-Romagna and Calabria to see whether the government still sticks to its posts, and from there on we can see whether the global trend in rates and in yields will be a downward one or a sideways one. My thinking is that this 1.5% on the 10-year rates in the United States is the floor. We haven't been able to breach it, and that bodes well for the yields to inch up as we move into 2020 rather than inching lower as they did for most of 2018.
I wanted to have a very quick look at the oil price. So far, we do see major decline by more than 2% of the WTI, $56 per barrel, and Brent $63 per barrel. As we can see, more than 1.5% lower this evening in terms of price. Of course, this happened after market surplus forecast by the International Energy Agency outweighed concerns over disruptions to Libya's and Iraq's crude output, that's for sure. So I was wondering, first of all, what is the outlook for the energy sector in 2020? Can we expect higher valuations now that climate change is becoming more and more, how can I say, modern topic, higher, much more of a problem, I wanted to say. And of course, it was one of the major topics at the World Economic Forum. So if we really are going to witness these measures that are supposed to be undertaken by the major companies and businesses, are we going to see further suffering of the energy sector, or as people say, the oil is there to stay?
I stick to the latter group. This global change theme is a long-term theme. Here and now, oil is necessary, and any continued contraction in investments in conventional oil operations will lead to an undersupply and a rally in crude oil prices. In the very near term, I've been contrarian, and you know that I made a bold call not to buy into the Libyan crude oil supply disruption, and I proved right, and we are $5 below that level. Yes, there is no very near-term concern that we have spare capacity around the globe. But low prices cure low prices, as we say. And we do know that shale operators have been steadily cutting down investments over the last semester. And this will be reflected into steady to lower production levels for 2020 in the United States. Now, does it mean that we are going to be in an oil undersupply? No. But that means that we will be dragging down the stock levels, the stockpiles levels, and that is bullish per se. So, yes, climate change is an issue, but for the next 6 to 12 months, there's no way we cannot use oil. And if we do not invest properly, and major oil corporations are being questioned on not to invest, that is one of the boldest calls from the Greta people, so to speak. They are asking for stopping investments now. If they ever succeeded, we will be running at $200 per barrel in 6 months' time. So, you know, being green doesn't mean that we need to be unrealistic in our demands. Oil is paramount, and yes, I believe that $55 is very much the floor currently because of the major downsized investments that have been planned for 2020 from the US operators. And that is going to be felt in the 2 to 3 months from now already.
And what kind of quarter earnings can we expect from the major US giant? They're going to report briefly, shortly, in terms of Q4 and, of course, the full year earnings results.
We would need to separate what is a one-time item, that is this major devaluation that have been brought down by the likes of Chevron, for instance, or EQT, and I do expect Exxon to make no difference as long as the shale operations are concerned. Once you write off those one-off items, results are still strong because margins are nice and fat, especially for the U.S. refiners. So I don't see issues earning-wise once you sanitize these one-off items. That will be big. If I'm not wrong, Chevron wrote down something like $16 billion for its natural gas operations in the United States. And many shale operators in Texas, in the Permian Basin, in North Dakota will be doing the same.
But you know what? I just wanted to point out that yesterday we saw a 2% decline of the natural gas trading below the $2, which is incredible. Remarkable also today's trading below the $2, 1.9, I believe, cubic meters or something. That was the metric, correct me if I'm mistaken. So we do see also major decline regarding the natural gas price, not only the oil.
Well, natural gas is a combination of factors, really. I am a bit of an expert also in that field, and I can tell you that the United States winter so far is one of the warmest on record. Now, you know that in wintertime, you need to burn natural gas to heat homes and businesses. So if the weather is hot or not as cold as it should, where is natural gas go? It's going to go into storage. And so natural gas prices are below $2 per British thermal unit, BTU, that's the unit of measure. It's because of weather. Production is amazing, but again, even there, production in this place, that is the shale place in the Appalachia region in the United States, those operations have been scaled down massively. So it does take time, but production will come off eventually. And that is when market is already alert to sense when that moment is going to be, and prices are most likely being testing for bottom hunting here on both WTI and natural gas.
I absolutely agree with you. Thank you very much, Domenico De Giorgio, professor at Cattolica University. Thank you for joining us. Thank you for your analysis, and have a great evening.
You too. Take care and talk soon. Bye.
Well, that was the last story for this evening. Thank you so much for watching, guys. See you tomorrow exactly at 6:45 p.m. on Le Fonte TV. Up next is President Trump's press conference at Davos 2020.